I think to kind of unpack what you were talking about there, it did feel like a very volatile year last year. Like you mentioned, with those big swings down to end the year so positive. But when you look at it in historical context, that was average volatility. And that's the thing
Mhm.
is while it feels in the moment, people like to always say, well, this time is different. And that is the most dangerous phrase maybe of investing. Because when you look at it, it was just normal volatility. And if you stayed the course, you ended up in a pretty good place, which I don't want to pretend like that's easy. That's the other thing too, is when we hear clients say, why don't I just own the S&P 500? That's not a horrible idea sometimes. Sometimes all you need is to keep up with the market and not drastically underperform. But that's not that easy when the market goes down 18%, because that means you're going down 18% with it. And in
Mhm.
years where international stocks like what we just saw do really well, you kind of missed out on some of that performance. Now, so that's the thing is you can invest like the S&P 500, but if you're going to do that, you still have to stick to the plan over the long term. And a lot of the data shows that's more difficult than people think. Morningstar does a study every year that looks at just US equity large cap funds. So think S&P 500 like funds. On average, what they're trying to do is measure the effects that investors incurred on themselves by getting in and out of the market, making emotional decisions. And over a 10-year period, investors are losing about 0.6% per year
Mhm.
from just mistiming the market. If they had just stayed invested, they'd be 0.6% better. So, yes, even some clients we have that I think we invest their portfolios much like the S&P 500 or whatever market cap index, whether it's global or dividend focused, we do that for clients. But where we can still add value maybe isn't necessarily beating the index by 3, 5%. It's by helping them stay invested and making sure they're not giving up 0.6% a year. And if you're going to do that, you can use ETFs, but there's other solutions too, like what we talk about with direct indexing, which different story for a different day. Check out our website. We have great articles on that. We can put the link in the show notes. But buying and holding an ETF, isn't easy. And there's better ways to get market exposure that are more tax efficient. So
Mhm.
that's kind of my like broad themes of 2025 is you didn't necessarily need to beat the market, but you needed to stay with the market throughout the whole year.
Yeah.
So it sounds easy, but it's really not. I wish it was as easy. It would make my life a lot better if everyone could stick to a plan, but I get it. It's emotional. Money is emotional. So
Right.